Let me tell you one thing. I am in awe of chartered accountants. Why? Because they are the smartest people on earth for me. I can't do number crunching, but they do fantastic number crunching. The advice that they get to the table is amazing. I, as a business owner, swear by what my CA says. Today, our presenter, when I looked at his profile, said, wow, he is a chartered accountant. Then surely the advice that comes from him is just not out of experience of his 12 years, but each and every advice that he has given to business owners, to individuals like you and me, will make that difference. And the number of things that he has to do on a regular basis, from advising on international taxation to business valuations, to being an independent director, and of the most being a member of ICAI, where currently he is holding a membership, a seat on the tax committee. With so much to do, what comes from him should surely be enough credible for us as a layperson to take those nuggets of wisdom, of experience and expertise and implement it in the way we handle, especially our taxation. We NRIs are, of course, have to look at that as well, because each one of us has some other income back in India. So how is it affecting us? If this person can make that small change of telling us what it is that we need to look for when it comes to NRI taxation, then I would say he has simplified life for us in this part of the world. With this, I call upon Mr. Niranjan Shah to take over the virtual podium with his presentation. Over to you, Mr. Niranjan.
Thank you, Anupama. Thank you very much for the wonderful introduction and kind words. Yes, the screen is visible to all, hope. Yes, okay. Sir, yes, to begin with, as I thank you, Forcy, for giving this platform to explain that wonderful topic on NRI taxation. Almost looking to the current scenario and cross-border movement of the employees as well as other parts of the people for the doing business. There are all chances that people are staying in India, outside India, on number of the days. Many number of the days. Sometimes COVID like situation has created very big hurdles for the income tax matters, because in India the taxation is based on the residency of the particular person. So before we start with any other topics and taxation of the India, we just need to understand what is the residential status of particular person in India. To begin with, see, what is NRI? Okay, non-resident Indians is not been defined under the Indian Income Tax Act. Income Tax Act doesn't differentiate than NRIs and other non-residents. NRIs has been defined differently for the FAMA purpose only. For the purpose of income tax, non-residents are those persons, those who are not residents. The simple words. So the question comes to our mind, who is the residents? Who are the residents in India for the purpose of income tax in India? So let's go to the definition of the residency for the test of the residency provided in the Income Tax Act. So first test is that person should be stayed in India for more than 182 days or more. Okay, so the first limb of the condition is that you should be there in India for more than 182 days. Okay, if you are not satisfying with this condition, there is another condition is that if you were in India for more than 365 days in past 4 years, and you are in current year, you are in India for more than 60 days, These are cumulative condition. Please note that this is cumulative condition for the particular current year. Current year means financial year. Let's assume 2021, 2022. In 2022, if you are in India for 60 days, okay, if you are in India, person is in India for 60 days, and in previous 4 years, if he was in India for more than 365 cumulatively, then he would be deemed to be the resident in India for the purpose of income tax. Now let's extend let's extend this definition. If a person of India going outside India for the purpose of employment, okay, then condition would be 182 days in current year, 182 days in current year, and 365 days in previous year. That 60 days has been replaced with 182 days. Okay. Now, if a person, if a citizen of India or a person of Indian origin comes to India for a visit, for short-term visit, and if he stays in India for more than for 182 days or more, and in previous year, if he was in India for 365 days or more, then he would be deemed to be the residents in India. So the here difference is that second limb of the condition is that you should be in India for 60 days and 365 days in previous year. But if you are the PIO or your citizens of India, you are coming into India for the visit purpose, then 60 days, even if you stay more than 60 days, then the limit of 60 days has been replaced with 182 days. That means you can stay in India up to 181 days. Even then you will be considered as a non-resident. Now another limbs has been added to currently by the department, by the CBDT or Finance Act. If a person or Indian citizen who comes to India for a visit, and its total income in India exceeds 15 INR, Indian rupees 15 lakhs, then he stays in India for 182 days has been replaced with 120 days there, 20 days. This is all the gamex of the number of the days to be staged in India, and based on that, it is decided that who will be the residents in India, and depending on the residency status, person would be taxable. Now, once you establish that you are a resident for the purpose of Indian income tax, there are two other things: you are ordinary residents and you are non-ordinary residents. Why this is the difference? Difference is that if you are ordinary residents, your global income is taxable in India. That means if you are staying outside India for some days, and you will be classified as a non-resident and ordinary resident, your global income is taxable in India. Even if you pay tax in other parts, you will be eligible for the credit in India, but India will tax the global income. Now question is that who are the non-resident, who are the ordinary residents? The person is said to be ordinary resident if he has been in India at least 2 years out of past 10 years. 2 out of 10 years he should be in India, and he has stayed in India for at least 730 days or more in past 7 years. Okay, so he would be considered as a non-resident of India. The ordinary resident, the definition of ordinary resident is that he should be resident of India in at least 2 years out of past 10 years, and he should be stayed in India for at least 730 days in last 7 years. This is an additional condition that is to be tested for the ordinary residency status. Not ordinary residents are the person who are not who are other than the ordinary residents, and the person who comes on a visit to India. That means the person who is coming to visit to India and his income is more than 15 lakhs, then he would be considered as a non-ordinary resident. Okay. Now another questions or another limbs for the capturing the peoples to taxation in India has been added, that is deemed residents. Up till now, this concept was not there in India. In India, residency status was decided based on only number of the days in India. Now this has been newly added that if you have a citizen of India, you have citizenship of India, and if you are earning more than 15 lakhs in India, okay, and you are not paying taxes in anywhere in the world. If that means you are not liable to tax in any other country other than India, then you would be considered as a deemed resident for the purpose of Indian Income Tax Act. So there are three types of status. One is residence of India, another is a deemed resident, and third is the not non-resident. So most of the NRIs are considered to be non-resident because they do not stay in India more than 182 days. So our entire discussion of the income and income tax filing would be based on the NRI status only. So hope you are getting properly what I am telling. So I'm proceeding further. So once you decided what is your residential status, then next step is to take which kind of income you are earning, which kind of income is to be taxable in India. So first is that we will decide the different kind of income. We will have an example of the another 3 to 4 5 types of income in India. We will decide what are the trigger events and what are the tax rates in India. Okay, salary income. See, if a person of Dubai is coming to India and is providing services from India, okay, that kind of salary is to be taxable in India. That means salary received in India or services rendered in India is to be taxable in India. This is the rule for the salary. That means salary is taxable in India only if it has been served from the Indian jurisdiction or the border of the India or land of the India. And the salary will be taxable at the slab rate applicable to individuals, and person will be given benefit of the deduction under section 80C, that is deduction of the investment, LIC, PPF you do have in India, whatever. And other deduction also are available for mediclaim, donations and other things. They are also eligible to get the minimum 2.5 lakhs threshold benefit. Now next source of income is house property income. So many of the NRIs do have the properties in India. They have given it to rent to the other person and Indian residents. Okay, so most of them are earning the income in India in the form of rent. Okay, generally people do have NRO account or NRE accounts in India. The rents will be credited to the NRO and NRO accounts in India. Okay, so rules in India is that any rent, any income you are getting it, the person who is giving you the rent, that they should have to deduct the TDS, that is withholding the taxes. Okay, and then that person will deposit the tax on your behalf to the department or government. Now the things comes to you that your tax has been deducted. Okay, let's out of 100 30 has been deducted. Okay, so you got only 70. So what about remaining 30? Say if you are not eligible, if your income is not more than 2.5 lakhs, okay, so you can claim the benefit of the minimum exemption limit while filing the return, and you can claim the refund. Okay, so while filing the return, you will get the, because in house property we have 30% deduction, standard deduction. See, if you have 100 rupees, you will get 30% deduction, and you will have to pay taxes on 70 rupees only if you are taxable at all. Okay, so let me put it other way around. If you have 5 lakhs income for the rent, okay, if you are earning 5 lakhs rent from the India, so out of 5 lakhs, 30% will be directly deducted, that 3.5 lakhs. Okay, 3.5 lakhs is a house property income in India, and you will get the benefits of let's assume 2.5 lakhs as a minimum exemption limit that is to be applicable to individuals. So you have to pay tax only 1 lakh rupees. That is assuming your tax, assuming the tax of rupees, assume 10,000 rupees. And then whatever TDS has been deducted, let's say assume TDS of rupees 1.5 lakhs has been deducted at the rate of 30%. So you will get the refund of 1,40,000. Okay, the standard deduction is also available. Benefit under section 80C is allowed. 80C is, as I told you, PPF, LSA, whatever you have invested in India for the retirement benefits or retirement planning, that you can get the benefits in India. Withholding is applicable, as I told you, and Form 15 CSCB is to be filed by the remitter of the fund. When you are remitting the funds to the non-residents outside India, so we have to file the Form 15 CSCB. At that time, this return and everything is applicable and very helpful. Another source of income is most of the peoples are investing in the Indian stock market or other way around. So they do earn regularly dividend income. The dividend income is taxable in India at the rate of 20%, and against which there is no deduction is allowed. It is flatly 20% tax payable. Interest income on NRI deposits, interest is totally exempt. Any interest income on saving or fixed deposit from the NRI account is exempt. There is no taxation in India. And other parts, that is NRO and other things, it will be taxable at the rate of applicable slab rate. Many of the people are earning royalty on patent, trademarks, or other know-how they do have in India, and also they have fees for technical services. So that is to be taxable at the rate of 10%, and no deduction is allowed against this. Now, most important part of the discussion is the capital gain taxation. See, many of the NRIs are frequently, all I would say, due to this liberalization and policy changes in current scenario. So people are investing more in India because India is the jurisdiction where they get more growth. So the taxation is much important because if you have long-term capital gain and short-term capital gain, there is a specific mechanism given under the act. If you have long-term capital gain on listed security, that is you have invested in the listed stock market, Indian stock market, that is BSE, NSE, and you are earning the long-term capital gain of more than 1 lakh rupees, the 10% tax has to be paid in India. Likewise, long-term capital gain on unlisted securities or shares. If you have invested in the private securities, you have to pay the taxation of the 10%, because while calculating the taxation of the 10%, you will not get the benefit of the inflation benefits. LTCG, long-term capital gain on unlisted securities and shares and other assets, it will be taxable at 20%. Likewise, long-term capital gain, short-term capital gain is also there. People are frequently trading in India, say buying and selling property, sales in online and stock market. So they will frequently on the most of the people are earning this short-term capital gain only, and they have to pay the 15% what we call tax, income tax plus education cess and surcharge is applicable as applicable. So investment income by NRI or LTCG on other than specified assets, it is taxable at the rate 20%. Specified assets are the shares of the Indian company, debenture, deposits, any security that certain government may notify in this regard. And LTCG on the sale of the specified assets by the NRI, it is taxable at the rate 10%. See, here capital gain income, that is special rates given for the taxation, that is 10%, 20%, 15%. While calculating the capital gain and taxation on this part, no deduction is allowed under any ATC or other deductions. Basic exemption limit is also not allowed, or any expenditure you have incurred for the purpose of earning this income is also not allowed. So now you have an income in India. You might have some other business income also in India. Other than this, there is a business income is there. And
Mr. Niranjan,
yes.
Just sorry to interrupt.
Yeah, please.
But Mr. Tejas, I think, has a question for you. Yeah.
Yes, please.
Would you like to take a question now or at the end of the session?
Better it would be end at the session.
Okay. So, Mr. Tejas, would you please just post your question on the WhatsApp number 055 6001 786, and Mr. Niranjan would take it up at the end of the session.
Sure.
Thank you, Mr. Niranjan.
Yes, thank you. Yes. Okay. Income tax return in India. So once you have income and source, you have decided the source of income in India. Next step is that you have to file the income tax return in India. So now I would like to understand the when the mandatory filing of income tax return is there and when it is an optional, and what are the benefits of filing the returns in India. Currently, there are 8 different income tax forms are available for different kind of person for file the return of income to report the income what you have in India, earned in India. So mandatory filing of income tax return is there only when your income is exceeds more than 2.5 lakhs. That is basic exemption limit. Second, a person who is willing to carry forward and set up the losses in the future. That means what it means. It means that if for a particular period, if you are doing activities in Indian stock market, or if you have sold your property in India, and due to some inflation benefits that Indian income tax is providing you, indexation benefit that I would call, your income you may have end up with the calculation of the losses. So let's assume the short-term losses or long-term losses, whatever it may be. So losses you have suffered in the current year. So the thing is that you need not to pay taxes in current year, correct? Now, if that losses, if you want to set up in the future income, say that is available for setup for 8 years. So if you have, let's assume you have a current year 1 lakh losses. Now that losses can be carried forward and set up for 8 years. That means if next year you have an income of rupees 2 lakh, against that you can get the setup of losses of the 1 lakh. That means you have to pay income on only 1 lakh rupees only. So that kind of benefit, if you want to take it, then you have to file the return compulsory. For taking this benefit, return filing is compulsory. If you have deposited amounts more than 1 crore in the current accounts, generally it is not applicable for the saving accounts. Incurred an expenditure of more than 2 lakhs for foreign travel, spending more than 1 lakh rupees towards the consumption of the electricity. This is generally applicable to the residents. If your total sales or gross receipt in the business exceeds 60 lakhs, if you have a business in India running in your name, you're shifted outside India. So, and if that business has an income of more than 60 lakhs, that is turnover of more than 60 lakhs, you have to file the return compulsory in India. Like in profession, that is 10 lakhs. The limit is 10 lakhs receipt. If you have a, let's assume if you have a TDS of 25,000 or more in current year, if you have somewhere, then it is compulsory to file the return in India. In your saving account, if your saving bank account, if you have deposited more than 50 lakhs in a current year, in a particular year, in that year return filing is compulsory. Person who are returning to India, so returning NRI, I would say those who are coming back to India, okay, if they have any assets that they are holding in their name outside India, remember, make it understand clearly. If you are returning from, let's assume, from Dubai to India, and if you are holding any assets in Dubai or any interest or financial interest in Dubai, then you have to compulsorily file the return in India, even if your income is below taxable, even if you have no income in India. Okay, so hope I am going little bit faster, or okay. Thank you, Anupama. Okay, there are some exemptions given to the filing of the return ITR to non-residents only. Okay, so what is the fundamental behind this? Fundamental behind this is, if you have only one source of income, let's assume you have only dividend income in India. Okay, and if dividend income, on that appropriate tax has been deducted by the payer, so income tax department will say you need not to file the return because you have already paid the taxes in India. You have no other source of income, so you need not to file the income in India. So there are list of the certain incomes on which if TDS or withholding has been appropriately done by the payer, then you need not to file the income tax returns in India. Okay, such kind of incomes are interest on bond issued by the Indian company under the specified schemes, that is foreign currency bonds, FCCB and other bonds. There are specific schemes that has been designed, and if you are earning interest from that scheme, you are only interest from this scheme, you are not liable to pay any file return in India. if you have purchased in foreign currency, as I told you, dividend on GDR or any dividend income, as I told you, if you have appropriately paid appropriately taxes in India, you need not to file the return in India. Interest received on the money borrowed by the government or whatever interest you are earning, and if on that interest appropriate withholding has been done by the payer, then you need not to file the income tax return. As distributed income for the special purpose vehicle, income from the units purchased in the foreign currency of the mutual fund. These are the all kind of specified instruments that have been royalties and FTS. In case of NRI, investment income from the foreign exchange assets, this has been specifically given for the NRI and to attract the investments in India. Okay, now most important thing and that everyone should know about this thing, and this is the very crucial nowadays, this becoming very crucial nowadays, because government is increasing penalties on the non-filing and other things day by day. So what are the due dates for filing the original returns? There are 3 to 4 types of returns. I will explain in detail. Original returns is that you file the return in time, that is due date prescribed here. What is the due date? Due date is that books of accounts are not required to be audited if you have only interest income, only dividend income, or other income on which TDS has not been deducted, and you are liable to pay tax, liable to file return. And even if you are voluntarily want to file the return, then you should file the return on or before 31st July, unless it is extended for due some reasons. Okay, books of accounts required to be audited. If you have a business in India and if your books of accounts are required to be audited, then you have to file the return on or before October 31st. And if your books of accounts are required to be audited and transfer pricing provisions are applicable, then November 30. Transfer pricing provisions are there when the two business entities, two related business entities dealing cross border. If I have a subsidiary in Dubai and I have a holding company in India, if both of them are doing any transaction for the goods and services, intercompany transaction, at that time transfer pricing provisions are applicable. That means you have to comply with the pricing regulation. That means whatever transaction you are doing, you have to justify that the transaction is not underpriced or not overpriced. That is the transfer pricing provision. If that kind of scenario and transactions you have incurred during the year, then your due date is extended for one more day, one more month, that is November 30. Revised return. If you have filed original return due to some mistakes or some errors or omission, you find that some income has been escaped. So you can, or some error has been occurred while filing the original return, you can revise that return till 9 months from the end of the financial year. Let's assume 21-22. You can file that up to December 22. Okay. Now the belated return. The belated return is an in case a person who has not filed return within original due date. That means your original return filing due date is July 31st for the individual. Okay. And if you have not filed the return within due date, then you have to file the return, whatever you have, you can file the return till 9 months from the end of the financial year. Okay, but with an extra penalty. The penalty is up to 5,000 rupees. But if your income is below 5 lakhs rupees, it is 1,000 rupees. Means before you file the return, you have to pay the penalty of rupees 5,000 or 1,000 as the case may be. Updated return. This is something new that has been introduced recently in Budget Finance Act 2022. That is, updated returns means if you have filed a return and after some period, let's say here it is given that from 2 years from the end of the relevant assessment year, means 3 years from the relevant financial year. So you can update your return for financial year 21-22 till financial year 24-25. That means 3 months from the end of the relevant financial year. So when it is when you can do this one, it is over and above the existing facility of the original returns. And in case you found any mistakes in during the 3 years, you can revise, you can update your return. But again, I would as I already told, additional tax of rupees 25 to 50%, 25 to 50%, that is a slab given when you will file the return. See, if you file before 9 months, 9 months, 9 to 12 months, after 9 months and before 12 months from the current financial year, then it will be 25%, otherwise it would be 50%. So you have to pay additional tax of 25 to 50% on updated return filing before you file the updated returns. Okay. Now, most important thing that is coming to you is what are the benefits of filing the return of India? See, if you have not income in India, so most probably you will think I need not to file the return in India. But it is more advisable from the my desk. I would say it would be more advisable to file the return due to following reasons. One is that, as I told, most of the cases, whenever NRI or non-resident is earning income from India, withholding is compulsory. Okay, in almost all cases, withholding is done by the payer. So that withholding, you may not be the taxable overall. You may not be the taxable because of the basic exemption limit you are enjoying, because of the some expenditure that you are incurring for earning that income. So it is a case that you can have a refund. Your tax liability may be less than the what TDS has been deducted by some other person. So to claim the refund of the TDS, it is compulsory to file the return. It is advisable to file the return in India. Okay. A valid return can be used as legal authentic documentation for any purpose like visa and other thing, because you have shown your income to the reporting authority or a third party and proper government authority. So any other government authority would rely on your this document before processing any request from your end. Reporting the financial transactions, means whatever you are doing activities in India, you have to report that. So means you are upfrontly reporting the transactions to the government. You can report your exempt income, what you are earning in India, undertaken during the financial year. This is why this is important, because it is very much useful when you want to remit the funds out of India. Means if you have an income in NRO account, if you have some income which is below 2.5 lakhs, okay, and NRO from either you will transfer from NRO to directly to outside India, or you may transfer to NRE accounts. At that time, you would need a certificate for chartered accountants that whatever amount you are going to transfer, these tax has been paid on this or not. So the chart before issuing the certificate, chartered accountant would check so whatever your amount you are going to remit and which source it is coming on, particular year you have paid the taxes or not. So at that time it is very useful for the chartered accountants or as well as for you, for NRIs, okay, to establish that income is already been tax paid properly. So the certification would be easy and you can get the remittance easily outside India. Okay, as I told you, to carry forward the losses, if you want to carry forward and set up the losses in current year, you can it is a benefit that you should file the return. That benefit can be availed only if you have filed the return of income. Okay, many of times what happens, even if you are not liable to file the return, or by some reason if you have escaped from filing the return, government or assessing officer will send you the notice why you have not filed the return of income. The basis of the not filing is that you might have on small interest income, small dividend income, small capital gain taxation, or any property you have buy in India. So the reason for this is they will ask for the source of income. First of all, whatever you are purchasing in India, they will ask for the source of income. And one is that whatever income you have earned in India on appropriate tax has been deducted or not. So if you have not filed the return of income, they will first catch the people who have not filed the return of income. Those who have PAN and they do not file the income return of income for the income escaping assessment. Okay, so to avoid such kind of the irrelevant notices from the department or income tax department, it is better to file the income tax return. It is to make it easy to get finance in India. See, someone is planning retirement, someone may plan to return to India or maybe retirement planning. So at that time, they may need to have some property in India, house property, let's assume. So at that time, if they want a finance from the bank, the return of income is more important, because while processing the loan and application, the bank will ask for the past 3 years record of the income. If you have even if you have white income, let's assume if you have a income in your bank account, they will not consider unless the return has been filed. So they will compulsory, it is a procedure inbuilt in all the banks in India. Return of income is must before processing of the any retail loan. Okay, your residential status you are reporting every year. It is much important because whatever the benefits you are getting for the non-residents or NRIs, that will easily can be passed on by the government, or government have a record of how many people are residents, how many are non-residents, and it is very useful for you also to claim a deduction as exemption. See, if you want to claim a deduction of whatever you have paid LIC and PPF in India, so for that you have to file the return of income only. So you cannot say, okay, I will claim at the time of assessment or something like this. While you are returning to India, if you suddenly file your return with some handsome income, it will raise a multiple doubts on you. So to maintain the consistency in filing, it is advisable to file the return consistently in India. So these are the benefits, not so, but we call practically we have faced such kind of issues. So based on that, I would summarize this kind of benefits for filing the returns of India. So now you decided to file the returns in India. Okay. So what would be the procedure? What kind of steps you should take? So first of all, you should identify the source of income in India. What kind of income you are earning, that is interest, dividend, capital gain, rent, business income, whatever it is. Okay. That source you should cross check with the appropriate document. That is if your TDS has been deducted, then from 16A it should be there. From 26AS it has been reported properly. From AIS, annual information system, the government is providing, and tax information system is governmental. It is a government portal. It is available on government portal. Every income you are earning, that is most probably more than 50 types of income are available in government portal. So if you have any, you invested in bonds 10 years 15 years back, you may not remember sometime. In one of the my case, I faced the situation. He has invested a bond in of 10 lakhs rupees. Okay, he got 1,20,000 as an interest. Okay, so while filing the return, he didn't get. Okay, and he even has not informed us, okay, this kind of interest I have earned, because he failed to he missed this one. So after processing of the return, government has issued notice to us, your income is short by 1,20,000. So I wonder why it is happened. So I just checked with the tax information system and annual information systems available with the government. So they have noticed from that, if you have a bond in India, invested bond in so and so country, you have earned income on so and so date, particular date they have given, and then we have to file the revised return and we have paid the taxes appropriately. So such kind of situations may be there in your case also, because you might your parent might have invested in your name, so you might not aware about this thing, but government knows everything, and if you are not filed the return in time, you will get the notice. Okay, so even if you are filing, you should cross check with the currently it is facility is available. This facility is available. Before you file the return, you should cross check with the available documents with the government. Then match the whatever receipt with your bank accounts, because sometimes it happens that banks it may not be credited, or sometimes it happens that bank it is credited, but you have not taken for the as a calculation of income. Then decide the taxability of the income under Income Tax Act. So what is the taxability? You should decide based on the nature of income. Check if any benefits are available under income tax, like ATC benefit, minimum exemption limit of 2.55 lakhs. If your income is allowing us to get the benefit, you should check that one. Prepare income tax return in appropriate form, that is appropriate form 1 to ITR 1 to ITR 8 is given, out of which you have to select any one. Then you e-verify the return or manually sign the acknowledgement and submit to the CPC. Now facility of e-verification is available for all. If you have other link, you can verify e-verify just by giving an OTP. Recheck your bank details in case of refund. It is most important, because many of the NRIs, I would say, have saving accounts. Actually saving accounts by NRI is not allowed by the RBI. The people are having that NRI account, saving account, that is not allowable. That is not correct thing. This is not legal. So while filing the returns, people are giving the what we call at the one end they are saying that I am non-resident. On the other end they are saying I have saving accounts. So while processing the refund, they will give the refunds to only NRO accounts. If you have NRO accounts, they will allow the refund. So check your bank details properly before filing the return. In recently, we are facing these issues because one of the client has a saving accounts in India. They are sitting in the Dubai. They have income in India. They have refund of rupees 50,000 something. But while processing the income tax return, the department has raised a query. You have a saving account, so you will not allow to be get the refund in your saving account. Kindly convert the saving account to NRO account, then update the banking details, and then get the refund. That process we are currently following up with the client. So these are the procedures for income tax return filings. Some other things I would like to highlight more on this part, because what are the consequences of not filing of the return? See, if you not file the return, what are the consequences? That financial consequences are that you would end up with the paying interest whenever at the time of whenever you file the return later, or whenever at the time of assessment you have to pay the taxes. You have to pay the interest and taxes and interest you have to pay at the time of assessment also. So as I told you, the department will issue the notice if you have not filed the return. Whenever they are sitting and they are analyzing the database, they will issue the notices based on the non-filers only. They first give chance to non-filers. Based on this notice, if they found there are any income which is being not reported to the department, they will make their own assessment of the income without considering anything. They will give their base judgment. Based on this, my base judgment, the income will be there. They are not hearing anything from the person or SSC, but it is applicable only where the SSC is not responding properly. If SSC is not responding properly, then they will end up with the base judgment assessment. Sometimes it happens you have concealed the income, because you have not reported income, it would be deemed that you have concealed the income. Intentionally you have not reported to the department. So that based on that, they will initiate the penalty for concealment, which is up to 100 to 300% of the tax liability. So eventually you have to pay the whatever income you have earned in India, entire amount as a tax and penalty in India. Imprisonment is also there if your income is escaped, and if you have not cooperated the department properly. The severe imprisonment up to 7 years is also provided in the act for the non-filing of the ITFs, if you're not complied or you're not filed the return in properly time. Okay, advance tax. If you have earned income, or if your tax liability is more than 10,000 in India at the end of the year for the particular year, you have to pay the advance tax in India. Certificate of lower deduction. What is this? If you have a source of income in India, payer has to deduct payer has to compulsorily deduct the TDS. Let's take an example. You have a flat in India. If you want to sell the flats to some NRI or some residents in India, that resident in India, before he remit the sales consideration to you, they compulsorily need to deduct TDS of rupees. Let's assume 20% is applicable TDS rate in your case. Okay, they have to deduct 20% TDS. Okay, now let's out of 10 lakh sales proceed, 2 lakhs will be deducted by this person. 8 lakhs in your hands. When you calculate the income tax and you get the indexation benefit, you end up with no taxation, or rather losses. Rather, you will end up with calculating the losses. At that time, you have to claim the refund. Instead of blockage of funds in TDS, you can apply to the department. Say that this is my sales consideration, this is my purchase price, this is indexation benefit available in under income tax act, and my income is so and so, so I will pay the taxes. Please give me the lower deduction, that instead of 20%, kindly allow me the 1 or 2%, whatever is applicable in your case. So this is a certificate of lower deduction. Condonation of delay for the filing of ITR. This is most beneficial provision. If you missed the filing of the returns, and if you have earned if you have a refund in India for last 6 years, you can claim the refund by filing an application with the commissioner, and you can claim the refund, past refunds in current period also. Authority of advance ruling. If anywhere you have doubt about your taxation in India or tax liability in India, you can apply to the authority of advance ruling. It is a specific body they will hear or fact, they will decide the taxability in your particular case, and it will be binding on both the party, even SSC as well as tax department. Treaty benefits. Treaty benefits, as far as Dubai is concerned, it is not much of importance because Dubai has no taxation, or rather would I would say that currently there is no taxation as far as individual is concerned. Corporate tax has been introduced, so at that time it will be helpful. So what is treaty? Treaty is a double taxation agreement between the two countries to avoidance of the double taxation, and to classify and to allocate the income and taxes properly. So currently India has more than 120 countries. India signed an agreement with the for the avoidance of double taxation. So to claim how it works, if you have taxable income in India, let's assume at the rate of 20%, you're liable to tax. But under the treaty, if government has agreed at the rate of 20%, or instead of 20, it is 10%, then you have to pay taxes in only 10% in India, not 20%. That means beneficial provisions out of Act and treaty is applicable to the SSC, and SSC can get the benefit of treaty. For getting the treaty benefit, SSC must have obtained the tax residency certificate of the particular country. So with that, I would like to end up this one. I would like to hand over the desk to Anupama.
Thank you, Mr. Niranjan. That was a master class in NRI taxation, I should say. It kind of opened a lot of queries in my mind. Forget about the audience. So let's look at what the audience have put up their queries. If you have any questions for Mr. Niranjan, please post them on 0556001786, and he will answer them for you. And if you have missed any part of this webinar today, in a day or two, it would be up on our platform, and you can watch again the entire proceedings at your leisure. Mr. Niranjan, there's one query. I think it is from Mr. Tejas Shah. He's asking, how about capital gain on mutual funds for NRIs from UAE, and how to claim in income tax form?
It is see, it is as good as the capital assets. Okay, so you can claim the same way the shares are being taxed in India. So mutual funds are different kinds of mutual funds. Equity oriented is there, and debt oriented is there. If it is equity oriented mutual funds, it will be taxable at the rate applicable to the equity shares. And if it is debt oriented, it will be applicable at the rate given for the other assets.
I hope that answers Mr. Tejas' query. I have a query for you.
Yes, please.
Yeah, I run a business in Dubai, and we have remote workers who work from India.
Okay.
So in this scenario, do we have to do this remote workers of us have to pay taxes in India?
If they are staying in India, and they are residents of India, they have to pay taxes in India.
Okay, so just because it is coming from outside of India, does not exempt them from paying tax.
No.
Okay. Currently, UAE has made it changes in their labor law, and we can have remote workers in our business.
Yes.
Yeah. So if this remote worker is traveling between India and UAE, in this scenario, what is the situation?
See, if they are traveling between India and UAE, let's take a recent example of a COVID-19 scenario. Okay, what happened in India? Whenever some employees comes to India and they stranded into India due to this COVID, so India is saying that if your stays in India is more than 182 days, you are the residents of India. Other parts of the world is considering the same scenario. So if you are in India for 182 days or more, how can you be the residents in other country? So the thing is that it will be taxable at the existing provision, applicable to the existing provision. That means if you have to pass through all the residency test that is given under section 66 of the Income Tax Act, if you are following the residency status, and if you are residents of India, okay, then you have to end up with paying taxes as per the applicable laws in India.
Okay. So tomorrow, if I decide to work remotely for my business, yeah. So
Yes.
whatever income I generate from my business, even though I'm staying in India, that would become a taxable income in India.
See, thing is that how you generate income. See, as far as your company is concerned, if you have established that you have permanent establishment in India by some reason, because you have an employee in India on roll and they are working for you in India, so there are chances that you should check the permanent establishment test. If if it is satisfied there, assuming that you have a PE in India, your company has to pay taxes in India.
So
That PE is a separate concept that is given under the treaty that you should test.
okay. So that kind of brings in a lot more clarity as what it's for individuals and what is for company, right?
Yes.
Yes. Any more questions for Mr. Niranjan, or should we call it a day? And thank you, Mr. Niranjan. Is that what we want to say? I can see Mr. Vinay, Mr. Sumit still on. So are there any questions from you, gentlemen? There is no reaction from them. If you do have any questions, please post them on 0556001786. That's a Dubai number, and we can tackle them and put them up on our platform for you to have a look at. With this, we come to the end of our webinar. Thank you, Mr. Niranjan, for that lovely 1 hour of insightful information.
Thank
I have
you.
been in Dubai for the past 26 years. I'm working here for almost more than 12 years, and I have not filed my income tax returns in India as yet.
Now
So
I
now,
hope you would start.
yes, and maybe that is one of the reasons which kind of triggered this
Yes.
webinar, because a lot of many people that I met here, and I asked them, are you doing this? Are you filing income tax returns?
Yeah.
And said, what is that? We don't do it. We are NRIs.
Yes. Yes. Yes.
Yeah.
Yes.
So I think that would change quite a bit of
It
way
has
we look
not
at indirect taxation.
even if technically is not required, it has a persuasive value rather, I would say, that you should file the return in India.
Yes. This has been an insightful 1 hour for me specifically, and it should be so for all those people who will look at this webinar when it's up on our platform. Uh, if any one of you would want to get back to Mr. Niranjan for further information, for more advice on how to file income tax returns in India, then of course you can catch hold of him on Niranjan at snssIndia.in. Am I right, Mr. Niranjan? I
Yes.
said it
Yes.
right.
Yes.
Okay,
Yes.
great. So that's where you can catch hold of him and maybe get your issues, queries, doubts sorted out. With this, thank you, Mr. Niranjan, for being on this webinar and giving us your time.
Thank
It was
you,
a wonderful
Anupama.
experience to listen to you.
Yes, thank you very much, Anupama and Forsi, to give this present opportunity to present before you and people of the Dubai, and hope this will be helpful to you as well as the those who are listening this in later on.
Thank you. Thank you
Thank
very
you.
much.
Thank you. Thank you.
Thank